So if you do want to ask questions, you see in the bottom left of your screen there's a box there. So please do ask questions both as we're going along, and we'll have a very much interactive piece doing that. We can also download the slides. That's down at the bottom of the left-hand side of your screen also. And finally, for those in terms of professional development looking for CP credits, then please enter your name and click the pop-up. So can I remind you that you have to stay the course of the whole webcast in order to gain all of those. So those are the housekeeping matters. Let me introduce our guest today on our webcast, which is Professor Colin Mayer, who's from the University of Oxford in the UK at the Said Business School. Professor Mayer is very well known for talking on this topic around corporate purpose, and he will start speaking with us very shortly after I give you a short introduction in terms of what the issue is today. I'll then hand it over to Professor Mayer, and we'll have questions as we go along. We'll also have a Q&A session towards the end, and we'll close just before the hour. So thank you again for joining us today. If we take our first slide here, what is a company for is the title of the webcast. And I know my colleague at Conference Board actually said to me when I gave her that title, is this correct? And I said, well, yes, this is the question that many businesses are actually asking now. What is the company for? Why are we here? And does doing the right thing pay by actually kind of addressing issues that are coming in? Increasingly, we see this issue raising up. And if I can point you to a New York Times article that was last week by the Mark Benioff, chair and co-CEO of Salesforce. He wrote an article which addressed many of the questions in this area and really pointed out that this is not a question of just addressing shareholders or stakeholders, but arguably in the future addressing both. And that's what we really want to focus on here, is actually how do you bring this agenda together. Now, we do live in quite unprecedented times. For example, a couple of statistics that support that. As you may have heard, I mean, the richest 26 people in the world have the same wealth as the poorest, lowest 4 billion in the world, i.e. the bottom half of the population. So 26 people versus 4 billion. And every day we see on the news now the impacts of the climate crisis and the impact that that's having on everyday life around the planet. So these issues are very, very kind of real. So we want to look at this within the webcast today and really look at this question about, does doing the right thing pay? Now, you may have seen in August of this year that there was many raised eyebrows when the Business Roundtable, which is a body that represents big companies in the US, around 185 CEOs put their name to a statement from the Business Roundtable, which said that companies should look at serving both stakeholders and investors. And this is quite a big shift, particularly in the US. It got, to some extent, a mixed reception, some being very positive, others, including the Vice President of the US, who was somewhat skeptical about this. But clearly this is now really on the table, and the message from the Business Roundtable has really kind of shifted the agenda. And it's not only in the States that we're seeing this. If we look at what's happened more in Europe around the Financial Times, here we can see on the slide the front page from a couple of weeks back, which says capitalism, time for a reset. The whole front page changed just for this issue. So we can see that throughout the world and throughout tier one kind of publications, that this now is kind of dominating what the FT, as you can see here, calls the new agenda that really has to be addressed. And if we look at our next slide here, because of the volatility, uncertainty that's happening in the marketplace today, it's making it very difficult for business people to make decisions. And we can see here from this evidence here about the economic uncertainty kind of index that we've got here, compared with what we were seeing maybe even 10 years ago. This index shows 3 or 4 times now more kind of uncertainty that decision makers are having to cope with, in terms of that much more volatile and complex environment that's out there today. And one of the consequences of this, both Colin and I were actually at an OECD event in the last few weeks, which was actually looking at trust in business, which is, as you can see from this slide here, one of the things that businesses experience is a declining trust, particularly in Western markets and increasingly around the world. And what we can see here again is that businesses are facing a kind of issue around what is the trust in business, and this is a decline around the world in terms of what should be done. Just a couple of more slides, and I'll hand it over to Professor Mayer. The first is in terms of what Nadella was talking about, the CEO of Microsoft at Davos this year, which is really around there have been very good parts to globalization. Many of people have benefited, and we've seen this, whether it's the cost of goods around the world, air travel, and many other things, which have been fantastic parts of globalization. But as he points out, there are also kind of some downsides of globalization, and he sees that Microsoft has to play a role in actually adding to what he calls the economic surplus of any country that they operate in. So we can see now, right at the CEO level, that the way that organizations operate and their purpose is very, very critical. And what's really important here is obviously how long an organization is going to be around. If we look at this particular slide here, we can see that not all firms are going to survive. If we take this example here of those big forces that we're talking about here and the shift towards stakeholder, but not all companies are going to survive. In fact, the S&P index here, the analysis here shows that in the last 50 years or so, it's gone from about 35 years down to about 15 years in that index. So companies' lifespan within that index is declining and quite rapidly. And we're seeing companies like General Electric, which left the Dow Jones last June after 114 years, as some of the unthinkables that were happening. So if I hand it off now to Colin, just one last point in terms of what we've got here is actually how organizations really rethink their purpose, their strategy, and how they align that more with their purpose about what they're doing in the marketplace and what they actually deliver, and how they can make doing the right thing pay. So I will, unless there are any questions now, I'll hand it over to Professor Mayer to actually kind of consider this kind of question in a little bit more detail and look about how companies should approach this issue in the future. Professor Mayer?
Chris, thank you very much indeed for that introduction. And let me pick it up where you left off by addressing 3 sets of issues. The first is, what do we mean by purpose, by a corporate purpose? Secondly, why is it important? And in particular, how does it actually contribute to promoting better corporate performance? And thirdly, how should one do it? How should one translate a corporate purpose into a real set of activities that deliver on those purposes? Now, on the first of those, purpose should be understood to be not just about making money. It's not just about profits. The purpose of a business is to produce profitable solutions for the problems of people and planet, and not to profit from producing problems for either people or planet. So purpose of a business is not per se to produce profits, but the purpose is the means by which a company can deliver purposes. And Larry Fink, the CEO and president of the largest investment management business in the world, BlackRock, put it very succinctly when he said, every business needs to have a purpose, not a strapline or a marketing campaign, but a statement of its fundamental reason for being, what it does on a daily basis. Purpose, he said, is not the sole pursuit of profits, but the animating force for achieving them. And everyone who runs successful businesses knows that to be the case. And what they do to achieve this is they first of all set out their purposes and they commit to the delivery of those corporate purposes. And they commit to those who help to create those corporate purposes. And that in turn encourages those other parties, such as the employees and the suppliers, to commit to help the company deliver on its corporate purpose. And that in turn gives rise to reciprocal relations of trust and mutual benefits, both for the firm and for the various parties to the firm. It creates more loyal customers, more reliable suppliers, more engaged employees, more supportive societies and shareholders. And that then gives rise to greater revenue, lower costs, and more profits. Now, underpinning this is exactly what Chris was saying is been in decline, namely trust in business. Because trustworthiness is an extremely important part of running successful businesses. And underpinning the trustworthiness of business is their culture, cultures of integrity and honesty and values of aligning and committing to the corporate purpose. Now, I want to illustrate this in relation to a particular company. It's a pharmaceutical company, and it's a large producer of insulin. It's one of the most successful producers of insulin, which is used in the treatment of type 2 diabetes. But a few years ago, it recognized that it was actually failing to deliver insulin to the parts of the world which were most in need of it. 85% of type 2 diabetes is found in low-income and middle-income countries. And in many of those countries, they simply couldn't afford to purchase the insulin that Novo Nordisk was selling. So what it did was it said, right, okay, we will cross-subsidize the price at which we sell insulin in developing countries from the profits that we make in developed countries. That was quite an interesting move, but it didn't profoundly change the nature of the business. What it then recognized was that actually its purpose was not simply to produce insulin. Its purpose was to help people who've got type 2 diabetes to treat it. And so it started working with doctors, with hospitals, with universities around the world to identify the best ways of treating type 2 diabetes. And then it realized, well, actually its purpose wasn't even simply to treat type 2 diabetes. Its purpose was to prevent people getting type 2 diabetes in the first place. And its stated mission and purpose now is to eradicate type 2 diabetes around the world. So it then set about working with health workers, with local communities, with governments around the world to identify how people could and should change their lifestyles to diminish the likelihood of them getting type 2 diabetes. Now, you might say, well, that's all very worthy and very noble, but surely it undermined Novo Nordisk's basic business model. And the answer was no, it did exactly the opposite. It caused the business to thrive. And the reason why it thrived was that it became a trusted supplier, not just of insulin or mechanisms of dealing with diabetes, but as a producer of products, of pharmaceutical products, and advice to medical practitioners, to hospitals, to governments, to community workers around the world. And that's it illustrates a number of very important points. The first is, what does one actually mean by a purpose? A purpose is neither simply descriptive of what a company does, in this case Novo Nordisk simply producing insulin, nor is it aspirational in the sense of, oh, we're here to save the world. It's very specific about what is the problem or the problems that it's trying to address, whose problems, what problems they've got, how they're going to deal with those problems, and why this company is particularly well suited to dealing with those problems. So what Novo Nordisk did was to recognize actually what its fundamental problem was about solving a problem of people having type 2 diabetes or getting type 2 diabetes in the first place. And it then set about thinking about how it can address that problem by building up relations with relevant parties around the world. And that's a key element in thinking about the question that I was raising in terms of how can one implement a corporate purpose once one's defined it with a degree of success. There are a number of components that are critical to companies being able to deliver on their corporate purpose. The first of those is the governance of the company, the corporate governance, and the way in which companies try and align their activities with their mission and their purposes. Traditionally, the view of corporate governance has been that it's about aligning the interests of management, and in particular the board of directors of companies, with their shareholder interests in the pursuit of profits and increasing and augmenting shareholder returns. But it's increasingly being realized that actually that is not the fundamental purpose of corporate governance. Corporate governance is about aligning the activities and interests of management and directors with the delivery of a corporate purpose. And this was acknowledged last year when the UK Financial Reporting Council brought out a new corporate governance code, which shifted the emphasis of corporate governance in Britain from being about aligning managerial interests with shareholder interests to being about aligning management interests with corporate purposes. And the second principle of that corporate governance code states that the board of directors must establish a company's purpose, strategy, and values and ensure that they are aligned with its culture. The directors must act with integrity, lead by example, and promote the desired culture. And then the next principle states that the directors should ensure that the company has the resources to meet its objectives and measure its performance by them. Now that sums up very well what's required to be able to deliver on a corporate purpose. Having identified what it is, then the directors and the senior management need to lead by example in establishing an appropriate and aligned set of values in the business, a culture that's conducive to those corporate purposes, ensure that there's the necessary investment in the business in activities that are required to deliver on those corporate purposes, and measure performance against the achievement of those corporate purposes. And that brings me on to the next two key areas, which are about measurement and investment. Measurement at the moment is predominantly associated with measuring physical capital and financial capital. And nearly all of the reporting that goes on in business is in regard to those. But increasingly there's been an emphasis on environmental, social and governance factors, ESG as they're termed, and an understanding that in addition to measuring physical and financial capital, one also has to measure the extent to which companies are contributing to their employees, to their workforce, to their societies, and to their natural environment and the environments within which they operate. In other words, that they don't just comprise physical and financial assets, that they depend on and impact their human assets, their social assets, and their natural assets as well. And they have to measure those. They have to measure them in the sense of having appropriate metrics that reflect the extent to which they're contributing towards, for example, in the case of Novo Nordisk, helping people to address problems of type 2 diabetes, or the changes in the lifestyle that are required to bring them that about. They can measure the extent to which they're successful against their purposes, and that's how one should be measuring performance, not just in terms of profits, but in terms of how well is a company delivering against its purposes. And then the final element that I want to emphasize is in relation to finance and investment. There's a great deal of emphasis in terms of finance, in terms of the ability to be able to repay loans, to be able to meet the expectations of investors in terms of their returns on their loans and their equity. And those are important, but those aren't the sole functions of financial systems. And a key element in terms of companies delivering on their purposes is to build up relations with other parties and invest in those other parties. Invest not just in their employees, but also in their supply chains, in their distribution chains as well. Invest in their environment and their natural assets so that they are supporting the elements that are required to create sustainable, purposeful businesses. And I want to just illustrate these thoughts around governance, measurement, investment, etc., by looking at another example. And this second example will come from what has been, over at least the last 10 years, one of the least successful sectors of the economy. It's in the financial system, and it's the banking sector. And I'm going to take a case of what has actually been one of the most successful banks, certainly in Europe, arguably in the world, over the last 10, 20 years. It's a bank that didn't need any bailing out during the financial crisis, that has delivered consistently high and increasing returns for its shareholders. It's one of the most financially stable banks, and it's one that has some of the best liquidity and solvency ratios of any banks around the world. It has a clearly defined purpose in terms of putting its customers first and also having one of the lowest cost bases of any of its rival banks. And it's been very successful on those scores in terms of having an unusually high level of customer satisfaction, which is reflected in turn in a repeated statement of a greater degree of loyalty on the part of its customers. And that illustrates one of the points that I was mentioning in terms of the reason why purpose is so important in terms of delivering success for companies, because of the trust that it builds up with its counterparties, in this case with its customers, who, because they feel better treated, are then more loyal to that bank than they are to other types of banks. It is one of the fastest growing banks in the UK, but it's not a British bank. It's a Swedish bank called Handelsbanken. Now, one of the things that's particularly interesting about that bank is the way in which it structures its activities and the governance of the bank in particular. And one of the elements of that is the extent to which it devolves decision taking in the bank. The mantra of the bank is that the branch is the bank, and everything is delegated down to the individual branches, and the branch managers are empowered to take decisions about everything in terms of who their customers are, the products that they sell them, the price at which they sell those products, and whether or not, for example, they give a loan to a borrower. Now, in traditional banks, and increasingly since the financial crisis, many of those decisions were ones that are being taken at a high level in organizations. And there's been an increasing concentration of control at the top of banks around the world. This bank has done exactly the opposite, devolving control down to the individual branches. Now, the importance of that is that it allows the branches and the branch manager in particular to take decisions about whether or not to extend a loan. They don't have to refer it up the hierarchy, wait for a decision to come back, and then say to their customers, I'm terribly sorry, the loan you've requested has been refused in the organization. And that, of course, allows the bank to build up those relations of trust with its customers. And what underpins the ability of the bank to be able to do that is the extent to which they are a humane bank. Humane not just in terms of the way in which they treat their customers, but the way in which they treat the people in the bank. So what they do is, in terms of selecting people for the branches, is they place a lot of emphasis in ensuring that they've identified the right people to operate the branches, and in particular to be the branch manager. They then instill the values and the culture of the bank firmly in those who are operating in those branches, and then they just allow them to get on and do their jobs without continuous supervision and intervention. And furthermore, another feature of the bank is it doesn't pay any of its employees any bonuses. Just remember how we're told repeatedly that one has to pay employees in banks bonuses because otherwise you can't recruit them or you can't retain them. Well, this, one of the most successful banks in the world, pays no bonuses to its employees, at least until they retire at the age of 60. It's a very long-term incentive mechanism, at which stage they get a share in the profit-sharing scheme of the bank, which is called octagonem. Now, this illustrates precisely what I was talking about in terms of the importance of having a governance system that is focused on purpose. In this case, in terms of putting the customer first and in finding a mechanism by which, in effect, the company, the bank in this case, is able to do that, being through devolving decision-taking in the bank. Secondly, in terms of measurement, namely that what is important for this bank is in terms of demonstrating that it has established good relationships, that it has, for example, long-term relationships with its customers, and measuring its performance in terms of those elements of customer satisfaction, which are key to its delivering on its purpose. And the third element, which is critical in this regard, is the extent to which it has been able to build up those elements of trust within the organization, as well as between the organization and its customers outside of the bank. And that in turn allows it to do the final element, which is obviously a key part of a bank, and that is to be able to invest in its customers. And it is in a position where it can extend loans, where in many over periods of time, which are longer than conventional loans, in circumstances in which in a conventional bank it might be very hard to do. So what I'd just like to end by doing is to emphasize the importance of this in thinking about some of the issues that Chris mentioned at the beginning in terms of the extent to which business has lost its way in terms of the trust of the relevant elements in society with which it interacts. And what both of these cases that I've mentioned, Novo Nordisk and Handelsbanken, illustrate very well is the significance of trust, the trust relationships that Novo Nordisk built up with the health professionals, with the local communities, the ones that Handelsbanken built up within the organization and with customers outside of the organization, and the way in which they were able to do that around the notion of corporate purpose, the reason why a company exists, why it's created, what it's there to do, what it aspires to become, and the fact that those corporate purposes are not simply about profit, they're not simply aspirational, they're not just descriptions of the products of companies, but they are about solving the problems that type 2 diabetes patients have, and the problems that those who need to borrow from banks and invest in banks face on a daily basis. And that element of trust is critically important, because trust is one of the most important assets that companies have, because trustworthy businesses are inherently commercially successful businesses, and the competitiveness of our nations and societies depends on the trustworthiness of our businesses for the prosperity of the many, not just the few, and the future as well as the present. Thank you.
Well, thank you, Colin. That was hugely insightful and some great examples there. I wonder if I could kick off with the first question, if that's okay.
Absolutely.
I thought it was interesting that the two examples that you chose are both from Scandinavia, and that is that by coincidence, or is there a certain lessons that we can learn from the way that some of the things you spoke about there, such as corporate governance and the way that these businesses are run, that can actually drive a much better kind of corporate purpose and strategy that delivers the kind of results that you just talked about? Or is it something that you see elsewhere in the world as well?
Well, that's a very astute observation, Chris, and it's absolutely right that both those examples do come from Scandinavia, from Denmark in the case of Novo Nordisk, and Sweden in the case of Handelsbanken. And that's not entirely by coincidence. It does reflect a number of features of Nordic and Scandinavian companies and economies which are important in this regard. And I'll illustrate that in relation to one element that is very important in terms of companies' ability to be able to deliver on their purposes. Because underpinning the success of a company to be able to do this is the nature of the ownership of a company. However committed a board of directors or senior management are to a corporate purpose, if they don't have the support of their owners, then it's very difficult for them to be able to commit to the various parties and build up the levels of trust that are required to do this. Now, the feature of the ownership structure that has arisen in Scandinavia is one of very active stock markets and companies listed on stock markets. Both Novo Nordisk and Handelsbanken are listed on their respective stock markets and actively traded. But it also has a feature of a combination of a lot of family ownership, and in particular in the case of Denmark, what is termed industrial foundation ownership. That is to say, companies that are owned by trusts or foundations. And that happens to be the case of Novo Nordisk, that it's an industrial foundation company and its largest shareholder is a foundation. Now, the importance of that stems from the fact that although it's actively traded on the stock market, that foundation is essentially an anchor shareholder. It can protect the company from the whims of the views of the stock market and ensure that it remains focused on its purpose over the long term. The foundations are in general established by founders of companies who, for one reason or another, don't want to pass on their companies to their children, perhaps because they haven't got them or because they don't like them, for whatever reason. They decide not to pass on their companies to their children, and instead they put their companies into a trust or a foundation. And the predominant purpose of those foundations is to uphold the purposes of the founders and the values of the founders and ensure that those persist in the company as it goes forward. Now, in the case of Handelsbanken, it's it's not an industrial foundation company, and it's not a family-owned company either. But while it's also traded on the Swedish stock market, is a company that has got two stable anchor shareholders. One of them is what I just described to you as being that profit-sharing scheme, Octagonen. So the bank's own profit-sharing scheme is the largest shareholder in the bank. And there's another one called Industry Varden, which is a Swedish holding company, where it just so happens that the largest shareholder in Industry Varden is Handelsbanken. So it's a cross-shareholding in essence, or in part self-ownership by the bank itself. Now, many people would say, well, that's the worst form of ownership one can imagine because there isn't any external scrutiny on the bank. But what it's given rise to is, again, a stable form of ownership, which has allowed the company to focus on the long term. So really the element that I want to bring out from those examples is the importance of the stability of ownership.
Thank you. If we still have some technology problems, I'll ask another question if that's okay.
Well, I've got a question that's just come in. So shall I just read it out?
You do. Okay. Yes. Please, please address that. That'd be great.
It comes from Annette Schuler, and thank you very much, Annette, for it. It says, even with the ESG factors gaining increasing importance, we also still have to speak the language of finance as well, if only to convince them to include more non-financial measurements in their matrices. Are there any hard measures correlating doing the right thing and financial success or longevity of a company? Okay, so that's a great question. To what extent is there evidence that there's a relationship between the extent to which companies are purposeful and emphasize things like ESG and the extent to which they are successful in traditional financial terms or indeed in terms of the longevity and survival of companies? And the answer is that there's evidence of both of those. There's evidence in particular that companies that are focused on purpose and focused on ESG measures perform better over the long term. There's one study that was done a few years ago in which the researchers compared 90 high sustainability companies with 90 low sustainability companies and compared their performance over an 18-year period from 1992 to 2010. And what they found was that over that period, the companies that emphasized ESG measures performed better in terms of their share price performance by 50% than those that were the low sustainability companies that didn't place so much emphasis on that. So there is evidence that over a long period of time of 10 or so more years, that one does indeed observe a positive influence of that sort. And there's also evidence that comes from those industrial foundation-owned firms that I mentioned a short while ago, that while they perform approximately the same in terms of financial terms as other types of similar companies of similar sizes in similar industries that are not industrial-owned companies, there's one way in which their performance differs markedly, and that is they survive much longer. They survive on average for around about 60 years as against the benchmark companies against which they're compared, which on average lasted for about 20 years. So they survive for about 3 times as long as their comparable non-industrial foundation-owned company.
So that's pretty compelling evidence. I was wondering if are there other questions that you have there, Colin, or?
I think at the moment I haven't got any other questions in, but if anyone would like to send them in, I would urge them to do so at this point.
So just while we're waiting for that, could I just maybe ask you around, in a way, what we're talking about isn't new. If you think about the quote from Peter Drucker that's often talked about, which is that that profit is a byproduct of what you do, and essentially what you've been talking about today is really kind of like focusing on what you do and doing it for the right reasons. So in a sense, that Drucker introduced this idea a while ago. But I mean, I suppose the question is, and you mentioned at the beginning about the new company law potentially in the UK around the FRC about actually mandating that companies actually address some of these issues. Do you think that this should be driven by government and policymakers, or is it something that should come from companies themselves and investors actually driving towards more of a kind of common purpose, if we can call it that?
Okay, so the answer to that is that it should be both. That first of all, the law, corporate law around the world is in general very permissive in allowing companies to do what they think appropriate. So for example, in the US, Delaware law is the most important base of corporate law because that's the state in which there are more companies incorporated than any other in the US. And according to Delaware law, the directors of a company should promote the success of the company as well as its success in relation to its shareholders. And the element of business leaders having discretion that comes from the fact that their business judgment is deemed to be the basis on which companies can operate, again, also gives directors a lot of room to determine how they should run their business. In the UK, the Companies Act explicitly says that the directors of a company must act in a way that they believe would be most likely to promote the success of the company for the benefit of its members, that is to say, its shareholders. And it then goes on to say, and in so doing, have regard amongst other matters to, firstly, the likely consequences of any decision on the long term. In other words, that they should promote the success of the company for the benefit of its shareholders over the long term, and having due regard to the interests of their employees, their suppliers, communities, environment, their reputation, so that the existing law basically says that directors of companies should promote the interests of other parties, other stakeholders, to the extent that it's consistent with promoting the success of the company for the benefit of its shareholders. So the law already allows both investors and companies to pursue ESG factors, to pursue the interests of their suppliers, employees, environment, etc., to the extent that that does not conflict with the interests of their shareholders. So coming back to what the Business Roundtable talked about in terms of delivering value for the customers, investing in employees, dealing fairly with suppliers, etc., and creating long-term value for their shareholders, the both US law and UK law is absolutely consistent with the ability of directors to be able to do with that. So the law is entirely permissive, but on the other hand, it's not protective. It's not protective in the sense that it gives assurance to directors that pursue a purpose that they would be protected against, for example, a hostile bidder or a hedge fund activist coming along with less emphasis on the purpose and the problem-solving element and simply more emphasis on driving shareholder returns. And another way of putting this is that although it allows companies to emphasize the interests of its employees, etc., in promoting the return of its shareholders, it still is implicitly an obligation on directors of companies to minimize their taxes, to minimize their wage costs, to the extent that that is consistent with increasing their shareholder returns over the long term and not undermining their reputation or not contravening the law. So long as they can reduce their costs in that way, or indeed potentially raising their profits through polluting the environment, then there's also an expectation and an obligation on them to do that. So it's a slightly two-sided coin at the moment in terms of being permissive. And what's required to be able to address that issue is to go a stage further from saying that companies can and should take account of their other parties, their stakeholders, to the extent that it benefits their shareholders, to saying that companies should state their purposes and demonstrate how they are fulfilling those purposes. And that's in essence what a form of incorporation in the United States, which is called the Public Benefit Corporation, explicitly does. A public benefit corporation is a legal form of a corporation by which a company has to state its purpose and demonstrate how it's delivering on those purposes, as well as delivering commercial returns to its shareholders. And that then allows a company to essentially establish the duties of directors, not simply to be in terms of promoting the interests of their shareholders, even in an enlightened sense, but also in terms of having an explicit purpose and stating that provided that the company is delivering on that purpose, then the law gives the directors a degree of protection against attempts to change those purposes.
Thank you for that, Colin. And I just wondered, in terms of any further questions that we have from the group.
I think at the moment we haven't had any further questions here.
Okay. So I just add one final question just to wrap up the webcast today, if I may, Colin, which is how do you see the future unfolding? If I may ask, it's a very difficult question in kind of the complexity and uncertainty we face today. But in terms of how corporations can deal with this, and what might be the ones that are more successful in the future, I think you've kind of hinted a number of times that you think that those, even based on evidence as well, that actually are going to be around and have longer lifetimes, are actually ones that actually can deal with these issues and actually put them into practice. Would that be the thing that you see in the future, which will differentiate, if we can say it, winners from losers?
Well, the answer is yes. There's been a dramatic change, as you were hinting at the beginning, in terms of the behavior of an attitude of companies, as indicated by the Business Roundtable and the Financial Times campaign on capitalism, time for a reset. And there's been a substantial change in terms of the attitude of investors, as illustrated by what I was describing in relation to BlackRock and the emphasis that's being placed on environmental and social and governance factors. And there's a good reason for this, because what's underpinning this sudden interest in corporate purpose is a recognition that the traditional way of doing business is simply not sustainable. It's not sustainable either in an environmental sense or simply in a commercial sense of the viability of companies going forward. Increasingly, investors are placing emphasis on material risks that come not just from the normal financial and commercial risks of companies, but also obviously from environmental climate change risks, but also from risks of regulation, political disturbance, social upheaval, etc. And those concerns are giving rise to, first of all, much more attempts at measuring the factors. So those measures of different types of assets that I was describing in ESG are really the first stage in terms of the systems of measurement that are being put in place. And there are moves now to think about how we change our accounting and reporting in such a way as to acknowledge and recognize the extent to which companies are either contributing towards promoting the interests of not just their customers, but also their societies and their environment, and really enhancing the well-being of their employees, and to what extent are they causing detriment. So that the very fact that we're changing the way in which we evaluate performance and measure performance almost means by definition it's going to be the case that companies that really take this stuff seriously are going to perform better, because the way in which their profits are going to be measured in the future are not simply against in terms of their revenues and the operating costs and the capital costs as they're currently being measured, but also to the extent that they are sustaining their environment, the extent to which they are investing in their employees and their societies as well. So that the notion as to what success is going to be in the future is going to be very different from the very basic and crude forms that have been used to measure that in the past. And we're gradually moving to a position where, just as at the beginning of the 1930s, there was a lot of confusion about measurement, but eventually there was the SEC that in 1932 and 33 set down the standards that then became the global standards for accounting. So too we're moving to a point where there's going to be a standardization of those ways of measuring performance that incorporate these other factors as well. Okay, I've got one more question, which I'll just very quickly read out, which comes again from Annette. So thank you, Annette, for being such a great contributor to this. She says, if I may pose a second question, would directors benefit from something like the business judgment rule in balancing their ESG purpose obligations and the duties to reduce costs, raise profits for their companies? Absolutely. So that is at the heart of really what a public benefit corporation is all about. It says that the fiduciary responsibilities of directors are not simply towards their shareholders, not simply in terms of delivering profits, but also in terms of thinking about what is the underlying purpose of the business and the extent to which the company is successful in delivering on that purpose. And so it's exactly what you're talking about there. It's balancing those elements of what underpins the purpose and what underpins the profit, the conventional way of measuring profit, and determining the relevant balance between the two. Because remember, what I described as being a purpose was the profitable solution to the problems of people and planet. Okay, so it's not about philanthropy, it's about profit. So you are generating profit, but you're also solving problems. And the issue that directors have to determine is what sort of balance between those profits and the solving of those problems is appropriate in their particular case.
Thank you, Colin. And what I'll do now is I'll actually draw the webcast to a close. I'm not sure if we can call it a webcast today with our technical problems. I do apologise for those today. They are very much apologise for them and any inconvenience that's caused. But we do hope that you've had an excellent hour. I think I would like to extend my thanks to Professor Colin Mayer. Thank you, Colin, for joining us today and a fantastic kind of contribution. Just to point out that we do have a related peer network, our Corporate Governance Council, which addresses some of these issues in Europe, and you can see that on your screen now. And with that, thank you again for joining us today, and I hope you enjoy the rest of the day. If you would click the webcast evaluation, we'd really appreciate that. That would help us with that. Once again, I hope you have a good day for the rest of the day, and hope you join us next time at the conference board for our webcast series. Thank you and goodbye. Hello.